I'm John Gomez with Santa Barbara Asset Management. I'm the president of Santa Barbara. Our firm is entirely focused on dividend growth investing. Our entire focus and philosophy is around finding well-run companies that can pay and grow a dividend. I think the importance of events like this is that you really get the chance to meet someone, talk to them face to face, hear what their concerns are, what the issues that they're facing, and then therefore it allows a greater dialogue on how our portfolio may fit in within the overall portfolio. Today we've been talking about dividend growth investing and the global dividend landscape for dividend growers. Ultimately, these last several years we've seen a worldwide phenomenon of interest rates dropping, and there's been this scarcity of yield. And investors have responded by bidding up the higher yielding elements of the market, whether it's utilities, telecom, or staples. So what we talked about today was really how we're navigating these waters and these currents, and how we're looking for companies that we feel are attractively valued, but also have the commitment to growing their dividend, and they have the fundamentals to continue to grow their dividend. The last several years have been very much a beta market. So if you got an exposure to the market just by either going indexing or just finding a manager that has a really aggressive profile, you've probably done really well, and this has been a very favorable environment for that. And again, there's been a lot of monetary stimulus, which has really diminished the value of active management. We now know that central banks are tightening, and therefore they're going to be making it a little bit more challenging for the beta-driven investors. But we think that active management should add a lot of value as dispersion returns, and as actually selection matters more. And so ultimately active management, I think, is going to have a very key role going forward. The easy money's been made, and now it's going to be more about selection, knowing what you own and knowing really the fundamentals behind those businesses. The typical issues that we hear when we go out and do a meeting is, how is a global dividend growth strategy going to handle a rising rate environment? And if we go back and look at the various tightening cycles that have occurred since the mid-90s, there's been 3 different tightening cycles. We're currently in another right now, but that hasn't completed quite yet. But during those rising rate environments, dividend growers, global dividend growers in particular, do really well because they're still exposed to earnings growth. And stock prices follow earnings. It's not an old, established, or stayed business that's paying out all of its dividends or all of its earnings in the form of a dividend. Dividend growers have a foot in both camps. They have a foot in the dividend world, but they also are still exposed to top-line growth, and so you have that element there. The second thing that we hear about is just volatility as a whole. As I mentioned earlier, volatility has been averaging much higher degrees than we've seen more recently. And we've just gone through a very low period of volatility, and eventually we'll see reversion to the mean. The pendulum will swing the other direction. Global dividend growers actually handle those periods of volatility really well. The reason being is that they're free cash flow generating companies with strong balance sheets. They're well-known franchises that investors trust during periods of uncertainty. And the third thing that people are concerned about generally, and investors are still grappling with, is valuation. Valuations collectively have risen the last several years. Equity markets have had a substantial run. But here again, selection matters. So what we've been doing is actually selling our higher yielding end of the spectrum within our portfolio. We've been investing those proceeds towards lower yielding securities. Every company in our portfolio has to pay a dividend. We've just been coming down in yield, and that's where you're finding valuation opportunities.